You're trying to buy a home and the numbers keep not working. You find a house you love. The rate on a new loan is 6.5, 6.8%. The payment is brutal, and you think there has to be another way. There is. It's called an assumable mortgage. Instead of getting a new loan at today's rates, you step into the seller's existing loan, their rate, their terms, everything. So if they locked in a rate of 2.75% back in 2021, that's your rate now. Here's the thing, the most common question I get is, what do you actually have to bring to the table? And that's where the equity gap comes in. The equity gap is simple. It's just the purchase price minus what the seller still owes on their loan. That's it. That's the number you need to cover. Say the home is worth $500,000 and the seller's loan balance is $425,000. Your equity gap is $75,000. That's what you're bridging, not the full purchase price. And most of the time, that number is a lot more manageable than people expect. Most assumption deals close somewhere in the 5 to 15% down range. Plenty come in at $50,000 or less. Now you're probably thinking, what if I don't have $50,000 sitting in cash? That's the part most people don't know. You got 6 ways to cover that gap. Cash is the obvious one. A second mortgage is probably the most common, where a partner lender bridges the difference. A HELOC on another property if you own one. Seller financing, where the seller carries part of the gap themselves. A 401k loan borrowed from yourself, or gift funds from family. I've got a lender who, if you put 5% down on a primary residence, will loan you the rest to cover the gap. That's it. 5% down, and you're stepping into a rate in the 2s or 3s on a home at today's prices. Here's the part that blows people's minds. On a $500,000 home, the difference between a 2.75% assumed rate and a 6.8% new loan is over $1,000 a month. $1,000 a month. That's a car payment that just disappears. That's a family vacation every single year. Occasionally, you'll even see deals where the seller has almost no equity, meaning the gap is tiny, basically zero out of pocket. That's rare, right? But it happens. The realistic range is what I'd plan around, 5 to 15%, and the coverage options are more flexible than most buyers realize. So if the equity gap has been the thing holding you back, it probably doesn't have to be. Find me on Instagram, The Assumable Guy, or head to assumableguy.com. Tell me your budget, and I'll show you what the numbers actually look like for your situation.